I am here in Los Angeles with the CEO of United Airlines, Scott Kirby. There is an incredible airline behind us. There are incredible exhibits here. We would be talking about all these new planes that United just bought, but instead the world has sent some other things. I really want to start with this question of how you plan for the future with a backdrop that is probably the most uncertain for airlines in particular since COVID.
Well, thanks for having me, Lisa, and I love the United Blue. But
it was a coincidence, but carry on.
You know, really, the way we plan is being prepared in advance. And when we came out of COVID, I made a commitment to our employees. I was going to do everything possible to put United in a position where we never again furlough employees, which has happened over decades, multiple times at United. And to do that, we knew there was some industry crisis to come. I didn't know what it was that would eventually come. But we're carrying triple the cash on the balance sheet that we had pre-COVID. We've moved to the top of the industry in terms of margins, and we have the best credit rating that we've had in over 30 years. And what that does is give us the financial resources to look to the other side of the crisis, to continue investing in airplanes like this, to continue a full speed investing in the future, while we make tactical adjustments in the short term, but have the financial resources that we can look through the crisis to the recovery on the other side.
You keep calling it a crisis. Last week, we heard from American, we heard from Delta. They were talking about even upgrading their forecasts for the year, saying that consumer demand was so strong it could overcome whatever short-term shock this is. You have a very different forecast. Why do you think it's not going to be that short-term and not that moderate?
So, first, I said exactly the same thing about demand. Demand is the strongest it's been ever. The top 10 booking weeks of the year have all been in 2026 so far. So demand is incredibly strong right now. But I do think that oil prices are, I think they're higher for longer. It's reasonable for us to plan for that regardless, because the downside is pretty limited. Like, we leave a little bit of demand on the table by not flying quite as much this summer. So what? That's not a big deal. But it gives us more optionality on the other side for the recovery. And so we're really focused on what the recovery is going to look like. And I think our forecast of oil going to 175 and staying through up to 100 to the end of next year is reasonable. I hope it's better, and there's a good chance it's better. But I think it's also reasonable. And planning and preparing for that really lets us come out stronger as we go through it and on the other side.
You've talked about how you're cutting about 5% of capacity, in particular in the Middle East and some of the routes there, in order to reduce capacity, preserve margins. Do you think that's it? Or if prices go even higher, do you expect that to actually be an even bigger cut to capacity?
Well, we'll watch and see what happens, particularly with demand. If our forecast of fuel prices is correct, then my guess is there's going to be an impact to the economy as well. And I hope not, but we'll watch that as it goes along. But what we're doing right now really is taking out flying that, is pretty marginal even in good times. And when oil prices double, it would lose money. And so there's just no point in flying flights that are going to lose money, that can't cover the cost of fuel. So it just seems reasonable to do it. We'll be nimble and see what happens with prices and demand.
The Middle East has been an area of expansion for a while. I know that a number of the airlines have really been moving heavily into the region. Are you adjusting any of your thinking longer term as a result of the conflict and potentially how long it could go on?
Well, we'll see. But I would guess that when this is over, that places like Dubai come back 100%. I don't know. We'll watch and see. But I would bet on Dubai for the long term.
Going forward, you've talked about how you want to take advantage of this time, how you see this as a crisis not unlike what we saw during the pandemic, and that you'd be even interested in potentially picking up some assets. What does that mean? Airplanes, routes?
So first, I don't think it's a crisis like COVID, but it's going to be a stress event. That's the word I use more, is stress event for the industry, if our fuel forecast is right. But it's nowhere near the magnitude of what happened in COVID. And in a stress event like that, I want us to we start in the strongest position. I want us to be consistently ahead of the curve. Like, every time there's something happening, I want us to be first to let everyone else follow. And when we're doing that, and others take longer to adjust, it is going to amp up the stress on them. Many of them start with weak income statements, weak balance sheets. And we'll be there to pick up some of those assets, and might be a win-win for them, but we'll be there to pick up some of those assets as we go through the crisis.
Wholesale acquisition of a company, or just piece by piece?
We'll see. There's lots of rumors about that.
Going forward, I'm curious also, there's been questions about hedging against oil prices. I know a lot of the airlines have really moved away from that because it hasn't been profitable. Delta has a refinery investment that has helped somewhat to offset some of these costs. Do you have any plans around that in any capacity?
We're so big, it's hard to effectively hedge. We're just so big. We move the market if we try to hedge. It's really hard to hedge the crack spread. oil prices have gone up. The crack spread has gone up even more. It's really hard to hedge there. So probably not. I actually tried to do a deal with ADNOC years ago when I was at American, and it foundered over a force majeure clause where they wanted, it had just been a swap, foundered over a force majeure where they said, well, we need a force majeure. And I said, well, that's the whole point. Like, what if the Straits of Hormuz closes? I said this 10 years ago. Like, that's when I want your hedge, and you can't get out of it. So it's just really hard for us to hedge.
Meanwhile, if this were the only crisis you'd be dealing with, probably you'd be watching this carefully, but you'd be grateful. There is also this question around all of the scenes that we see in social media, et cetera, of TSA lines getting longer and longer. Have you noticed people missing their flights? I mean, how big of a problem has this been for United?
Thank you to the TSA agents. The vast majority of them are showing up to work, and I understand. Like, it's unconscionable that our politicians are put our TSA agents, safety professionals, in a situation like this. But they're showing up to work. I love saying thank you to them every time I go through. They're doing a great job. Yes, there are places where we've had long lines. It's really the last week that it's started to increase a little bit. I am hopeful that we're near the finish line. I'm on my way back to D.C. after here, but I've been talking to folks in the Senate on both sides of the aisle. It does feel to me like we're close. This feels like kind of like the FAA felt, where we're 48 hours away when we got the FAA reopened. Feels very similar to me that we're close, I hope, to having it resolved.
Does having ICE agents there help things or hurt things?
I don't know. We're all trying to provide resources to TSA. We and other airlines are doing things like providing meals and offering to use our staff to help with lines or to help with the exit, monitoring the exits. Those are the kinds of things that the other government officials are doing. So
you've run companies.
The key, though, is get TSA funded and pay the people.
You've run companies for a long time. Have you ever spent more time in Washington, D.C. as a CEO?
Boy, I spent a lot of time there. I've spent more there probably this year than any other year, though.
Do you feel like the system is fraying in terms of also safety issues? I mean, there's been a lot of concern about what happened with LaGuardia Airport.
Yeah, the system is safe. It really is safe. It's by far the safest way to travel of any mode of transportation. And I do think that we need to invest more in the FAA, both in staffing and then the technology. And I am this is the first time in my career we've had an administration, Secretary Duffy, Administrator Bedford, that are fully committed to doing that. And they are doing it. And staffing in Newark, for example, it's the best it's been, in my career. And we think we're going to be 100%. It'll be the first time ever, I think, that we'll be 100% staffed later this year. So they're on that road. The Secretary is about to ask, I think, for another $6 to $7 billion for technology. I will encourage everyone on both sides of the aisle. Let's do a bipartisan deal to get that done. That's what we need to invest in our.
In the meantime, we have consumers that have been incredibly resilient through all of this. They still want to travel. I mean, at what point do you start to see cannibalization? Are you starting to see any pushback?
I'm sure there will be some. There is always a price elasticity. But we're starting from a perspective where airfares in 2025 were 2% lower than they were in 2019, even though inflation was up 25%. So airfares are up 15 to 20% in the last few weeks. But that's sort of covering half to 60% of the inflationary increase. So I think we have some room to go. But I also think, there will be less demand. There'll be fewer people traveling as prices go up. That's part of our cut capacity 5%. When airfares have to go up because of oil prices, there are going to be some people that choose not to fly, and it'd be naive not to realize that. And so printing back some of that capacity is a rational response.
How much do you expect prices to have to go up just to adjust to the oil prices?
Well, if oil prices stayed where they are today, that's $11 billion of expense for us. And that would require prices to be up 20% to break even, to cover that cost.
Meanwhile, you are announcing all of these new planes. A lot of them have put a real emphasis on the premium customer, Polaris, on the both states, the bi-coastal kind of transit. You've talked a lot about how premium is the future. Can you talk about how much it really is the growth sector and whether demand there continues to be robust?
Well, the truth is we're investing nose to tail for all customers. I mean, everybody gets the best technology, best app technology in the world, Starlink, seatback entertainment. So it's not just premium. Premium gets a lot of the press, but we're investing nose to tail to win customers, brand loyal customers everywhere. But clearly the premium demand has been much stronger than anyone ever realized. And what I really think, it's not that premium demand is higher today than it was. It was always there. We didn't have the product to serve it. And once we create the product, we realized that there's demand that was in excess of what we knew. Also at United, like we were born on third base when it comes to premium, with hubs in Newark, Dulles, Chicago, San Francisco. Like sometimes it's good to be lucky. We were born on third base where there's far more premium demand for our product, and so it lets us be the leader.
Scott Kirby, wonderful for you to take the time. Thank you so much for being here.
Lisa.
Wonderful to speak with you. That was Scott Kirby, the Chief Executive Officer of United Airlines, and I'll send it back to you.